Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The world of insurance is complex and varies significantly by state and individual circumstances. Always consult with a qualified professional before making any financial decisions. Your specific needs are unique, and this presentation is not a substitute for personalized advice. You get the bill in the mail, or maybe it's an email notification. Your heart does that little tap dance of dread. You open it and there it is, your car insurance premium, and it went up. Again, for no reason you can think of. No accidents, no tickets, you haven't even changed your address. But that number is bigger. Feels like you're being punished for just existing, for just owning a car. Feels unfair. Feels like a scam. Sound familiar? You are not alone. Millions of Americans feel this exact same frustration every 6 months. They feel trapped paying a bill that just keeps climbing for a service they hope they never have to use. But what if I told you that the game is rigged, but you've just never been taught the rules? What if the reason you're overpaying isn't because of your driving, but because of what you don't know? Your insurance company is counting on you to just sigh, pay the bill, and move on. They are not going to call you up and say, hey, you could be paying us $300 less if you just click this one box. That call is never coming. Well, consider this video that call. Over the next few minutes, we are going to pull back the curtain on the entire auto insurance industry. I'm going to arm you with the knowledge you need to stop overpaying and start finding the low-cost auto insurance that's right for you, without sacrificing critical protection. We are going to demystify the jargon, expose the common traps, and reveal the strategies that can slash your premium, sometimes by hundreds, even over $1,000 a year. We're talking about understanding what minimum coverage really means for your wallet, uncovering discounts you probably qualify for but don't know exist, and learning the right way to shop for insurance that forces companies to compete for your business. This isn't about finding some magical one-size-fits-all cheap policy. This is about making you smarter than the system. It's about giving you the confidence to look at your policy, understand every line, and know without a doubt that you are getting the best possible deal for your specific situation. Now, I know what some of you might be thinking. I've tried shopping around, it's a hassle, and the prices are all about the same. Or, I have a bad driving record, so I'm stuck paying a fortune no matter what. I hear you, and I'm here to tell you that those are myths, often perpetuated by an industry that benefits from your confusion and resignation. The truth is, with the right strategy, nearly everyone can find a better option, especially now. With the cost of everything from gas to groceries going through the roof, finding an extra $50, $100, or even $200 a month in your budget isn't just a nice to have. For many families, it's a necessity. That money is the difference between stress and stability. So let's start with the biggest and most misunderstood concept in low-cost auto insurance: state minimum liability. Every state, with the exception of New Hampshire, which has its own unique rules, legally requires you to have a certain amount of liability insurance to drive a car. This is the absolute bare-bones, cheapest plan you can legally buy. And because it's the cheapest, a lot of people automatically assume it's the best deal. This is trap number 1. Buying state minimum insurance is like showing up to a 5-course dinner with only a fork. You're technically equipped to be there, but you are wildly unprepared for what's about to happen. Let's break it down. Liability coverage doesn't cover your car or your injuries. It covers the damage you do to other people and their property if you cause an accident. It's typically shown as a series of 3 numbers, like 25/50/25. Let's use California's minimums as an example, which are 15/30/5. That first number, 15, stands for $15,000. That's the maximum amount your insurance will pay for the medical bills of a single person you injure in an accident. The second number, 30, is the maximum they'll pay for all injuries combined in a single accident, no matter how many people you hurt. And that last number, 5, is $5,000. That's the maximum they'll pay for all property damage you cause. That means the other person's car, the mailbox you hit, the storefront you crash into, everything. Now let that sink in. $5,000 for property damage. Have you looked at the price of cars on the road today? The average new car costs nearly $50,000. Even a 5-year-old used Honda Civic can be worth well over $15,000. So, you have the absolute cheapest legal insurance. You're trying to save money. You have a momentary lapse in attention, you glance at your phone, and you rear-end a brand new Ford Explorer. It's a minor fender bender, nobody's hurt, thank God. But the repair estimate for the Explorer's bumper, sensors and liftgate comes back at $12,000. Your rock bottom. Great Deal insurance policy pays the first $5,000. You are now personally legally on the hook for the remaining $7,000. That's a $7,000 bill you have to pay out of your own pocket. And what if the person is injured? What if their medical bills are $40,000? Your policy covers the first $15,000. You are now being sued for the remaining $25,000. This is the terrifying reality of being underinsured. If you can't pay, they can go after your assets. They can garnish your wages, meaning they take money directly from your paycheck every single week until the debt is paid. They can put a lien on your house. That cheap insurance policy could end up costing you your savings, your income, and your financial future. The few dollars you saved each month suddenly become the most expensive money you've ever spent. So what's the answer? Am I saying you need to buy $1 million policy? No. But here's the secret that the insurance industry doesn't want you to know. The jump from a dangerously low state minimum policy to a much safer, more responsible level of coverage is often shockingly cheap. We're not talking about doubling your premium. Sometimes, going from that 15/30/5 policy to a 50/100/50 policy might only cost you an extra $10 or $15 a month. Why? Because insurance companies are all about risk. When you choose to buy only the bare minimum coverage, you are signaling to them that you are a higher risk. You're either in a tight financial spot, or you're just trying to get away with the absolute least you can. But when you voluntarily choose a higher level of coverage, you signal that you are a more responsible person. You have more to protect and you're thinking about the consequences. In the company's complex algorithms, you look like a safer bet, and they often reward that with a much better rate per dollar of coverage. So the first step in your journey to finding truly low-cost insurance is to reject the myth of the state minimum. Get quotes for several levels of liability coverage. Ask to see the price for 50/100/50. Ask to see 100/300/100. You will be stunned at how little the price difference can be for an exponential increase in your financial protection. This is the foundation of smart insurance shopping. It's not just about finding the lowest price. It's about finding the most value and protecting yourself from financial ruin. This is just the beginning. Understanding liability is step one. But the world of low-cost insurance goes so much deeper. There are entirely different types of insurance products designed for specific kinds of drivers, from pay-per-mile insurance for those who barely drive, to usage-based insurance that rewards you for safe habits in real time. And then there's the big one, the question so many people are afraid to ask. What if you have a less than perfect driving record? What if you have a DUI or multiple accidents or a lapse in coverage? Are you just stuck paying a fortune forever? The answer is a hard no, and there's an entire segment of the industry built to help you. This corner of the insurance world is called the non-standard market. And while it has a slightly intimidating name, its purpose is simple: to provide a safety net, a second chance, for drivers that the big preferred insurance companies have deemed too risky. Think of it like this: standard insurance companies are like a bank offering a prime mortgage. They only want to lend to people with perfect 800 credit scores, stable jobs, and a big down payment. But what about everyone else? What about the person rebuilding their credit after a tough time? Or the freelancer with a fluctuating income? They still need a place to live, right? They go to lenders who specialize in their exact situation. The non-standard auto insurance market is that specialist. It's not bad insurance. It's not a scam. It is state-regulated, legitimate coverage designed specifically for the driver profile that gives standard carriers heartburn. So, who exactly ends up in this market? You might be surprised. The most obvious candidate is the driver with a major violation, like a DUI or a DWI. That's an automatic red flag for any insurer. But the list is much, much longer. It includes drivers with a string of at-fault accidents in a short period. If you've been in 2 or 3 crashes that were your fault in the last 3 years, you're almost certainly a candidate. It also includes drivers with a collection of speeding tickets or other moving violations. 1 ticket probably won't do it, but 3 or 4. You're starting to look like a pattern of risky behavior. Here's a big one that catches millions of people off guard: a lapse in coverage. If you let your insurance expire, even for a few weeks, because you sold your car or couldn't make a payment, insurance companies see that as a massive risk. In their eyes, a responsible person maintains continuous coverage. A lapse to them signals instability. And they hate instability. So when you go to get a new policy, you'll find the quotes are shockingly high. You've been branded a risk, not for your driving, but for your insurance history. Other groups that often land in the non-standard market include very young, inexperienced drivers, especially males under 25 who statistically have the highest accident rates. In most states, drivers with poor credit scores will also see much higher rates and may be pushed towards non-standard options, because data shows a correlation between credit management and driving responsibility. And finally, there's a specific group who are required by law to be here. Drivers who need something called an State Route 22 or an FR44 filing. Now these terms, State Route 22 and FR44, are some of the most misunderstood in all of insurance. Let's clear it up right now because it's not as scary as it sounds. An State Route 22 is not insurance. You can't buy an State Route 22. An State Route 22 is simply a piece of paper, a certificate, that your insurance company files with your state's DMV. It's a certificate of financial responsibility. It's the insurance company basically telling the government, hey, we've got this person covered. They have at least the state-mandated minimum liability insurance, so if they cause an accident, we're on the hook. You're typically required to have an State Route 22 after a serious offense, like a DUI, a conviction for driving without insurance, or a reckless driving charge. The court or the DMV will sentence you to, say, 3 years of needing an State Route 22. This means for 3 straight years you must have an active car insurance policy, and your insurer must be guaranteeing it to the state. If you miss a payment and your policy gets canceled, the insurance company immediately tells the DMV they're no longer covered. The DMV then promptly suspends your license again. It's a leash, a way for the state to make absolutely sure you stay insured. And here's the key. Not every insurance company offers State Route 22 filings. The big preferred carriers often don't want to deal with the paperwork or the high-risk clients associated with it. So, by necessity, you have to find a carrier in the non-standard market that does. The FR44 is the SR22's bigger, tougher cousin, and it's only used in Florida and Virginia. It's also a certificate of financial responsibility, but it's reserved for very serious alcohol or drug-related driving offenses. The main difference is the amount of insurance it requires you to carry. While an State Route 22 just requires you to have the state's minimum liability limits, an FR44 forces you to buy much, much higher limits, often double or quadruple the state minimum. The logic is that if you've proven to be an exceptionally high risk, the state wants to ensure there is a much larger pool of money available if you cause a catastrophic accident. So you're in this high-risk pool. You're paying a lot more than your friend with a perfect record. Is this a life sentence? Are you stuck here forever? Absolutely not. This is the most important part. The non-standard market should be a temporary stop, not a final destination. Your goal is to graduate. You want to get back into the standard preferred market where the rates are dramatically lower. And there is a clear, defined path to do it. First, you need to understand that time is your greatest ally. Your driving record is not permanent. Most minor violations and at-fault accidents will fall off your record for insurance rating purposes after 3 to 5 years. Major violations like a DUI can stick around for much longer, sometimes 7 to 10 years depending on the state and the insurer. But the key is they do eventually fade into the past. Second, and this is non-negotiable, you must become the world's safest driver. Starting now, the clock on your rehabilitation only moves forward when you're not adding new problems. One new speeding ticket, one more little fender bender, and you reset the clock. You prove to the insurance companies that their assessment of you as high risk was correct. You have to be flawless. This means no speeding, no rolling stops, no texting and driving, nothing. Drive like your license and your bank account depend on it. Because they do. Third, be proactive. Many states allow you to take a defensive driving course to dismiss a ticket or to get a small discount on your insurance. Do it. It shows insurers that you're taking your situation seriously and actively trying to become a better driver. It's a small signal, but it helps. Fourth, and this is critical, maintain continuous coverage. Once you have that non-standard policy, you cannot let it lapse for any reason. A lapse is a self-inflicted wound that will set you back years. It's better to reduce your coverage to the bare minimum state requirement than to cancel the policy altogether. Consistent payment history and 0 lapses prove you are becoming a reliable, responsible customer again. After you've strung together 3 years, 3 solid years, of perfect driving, no claims, no tickets, and no lapses, it's time to go shopping. This is your graduation day. You can now approach the standard insurance carriers again, but this time you have proof. You have a 3-year track record demonstrating that your past is in the past. You are no longer the same risk you were. You can also work with an independent insurance agent. These agents are invaluable because they have access to dozens of companies and they are experts at this. You can tell them, I've had a clean record for 3 years, my state Route 22 requirement is over. I'm looking to get out of the high-risk pool. They will know exactly which carriers are most likely to give you that second chance with a much better rate. This process is a journey from being defined by your worst day on the road to being defined by your consistent, responsible behavior over a period of years. It takes discipline, it takes patience, but it is a guaranteed path back to affordable insurance. But this raises a different and perhaps even more common question. What if you're not high risk at all? What if you have a perfectly clean driving record, you've never had a lapse in coverage, you've done everything right, but you're still struggling to afford your premiums? You just need the absolute cheapest policy possible to legally drive your car to work and back. You turn to the option that seems like the most obvious solution: state minimum liability insurance. It's the lowest level of coverage you can legally buy. But is the cheapest option really the best one? Or could buying that bare-bones policy be the single most expensive financial mistake you ever make? The answer might change how you think about insurance forever. To understand this, let's meet Mark. Mark is smart. He's 28, has a decent job, and is aggressively saving for a down payment on a house. He tracks every dollar. He uses budgeting apps, he meal preps, he's the king of finding a good deal. So when his car insurance renewal came up, he did what any financially savvy person would do. He shopped around. He got quotes from 5 different companies, and he found one that was significantly cheaper than the others. $35 a month cheaper. Over a year, that's $420. That's a meaningful amount of money he could put directly into his house fund. The catch? To get that low price, he had to choose the state minimum liability coverage. In his state, that was $25,000 for bodily injury to one person, $50,000 total for all injuries in an accident, and just $10,000 for property damage. He looked at the numbers. $10,000 to fix a car? Seemed reasonable. $25,000 for medical bills? Seemed like a lot. He thought, I'm a safe driver. I've never even had a ticket. So he clicked buy. He felt great. He felt like he had just outsmarted the system, saving money that insurance companies just wanted to pocket. For 6 months he was right. That $420 was sitting in his high-yield savings account, earning interest. Then came a rainy Tuesday afternoon. Mark was driving home from work, thinking about dinner. The car in front of him, a brand-new-looking SUV, stopped suddenly. Mark's mind was elsewhere for just a split second. His foot was a little slow moving to the brake. The crunch of metal was sickening. It wasn't a high-speed crash. Nobody seemed hurt. Mark and the other driver, a woman named Sarah, pulled over. They were both shaken but okay. Mark's old sedan had a crumpled hood, but Sarah's SUV just looked like the rear bumper was dented and the tailgate was a bit mangled. Mark did everything right. He exchanged information, he took pictures, he called his insurance company immediately. He was frustrated, but he thought, this is exactly why I pay for insurance. They'll handle it. The first phone call came a week later. It was from his insurance adjuster. The estimate to repair Sarah's SUV had come in. It wasn't just a simple bumper replacement. Because it was a new model, it had sensors for blind spot monitoring and parking assist embedded in the bumper assembly. The tailgate had a complex electronic latch and was made of aluminum. The total cost for parts and labor was $17,600. Mark's heart sank. He remembered the policy document. His property damage limit was $10,000. The adjuster confirmed it. We'll pay our limit of $10,000, she said calmly, but you will be personally responsible for the remaining $7,600. Suddenly, Mark's $420 in savings seemed like a cruel joke. He had to drain a huge chunk of his house fund just to fix someone else's bumper. He was angry, stressed, but he figured he'd learned a very expensive lesson. He'd pay it and move on. But that wasn't the end of it. It was only the beginning. 2 weeks after that, Mark received a thick envelope in the mail. It was from a law firm. The letter stated that their client, Sarah, had been experiencing severe neck and back pain since the accident. She had been diagnosed with whiplash and a cervical strain. She was seeing a chiropractor, undergoing physical therapy, and had missed 2 weeks of work as an office manager. The letter included copies of her initial medical bills, which already totaled over $12,000, and a projection of future treatment costs, plus a demand for her lost wages. The grand total they were seeking was $38,000. Mark felt the blood drain from his face. He called his insurance company again, his voice trembling. The news was even worse. His bodily injury liability limit was $25,000 per person. His insurance would negotiate, they would fight for him, but their legal obligation ended at $25,000. Anything above that was, once again, Mark's personal responsibility. If Sarah's claim was successful, he would owe her an additional $13,000, on top of the $7,600 he already owed for her car. That's a total of $20,600. His entire down payment gone. Worse, Sarah's lawyer could get a judgment against him. They could garnish his wages, taking money directly from his paycheck every week. His dream of buying a house wasn't just delayed, it was evaporating before his eyes. All of this entire financial nightmare, stemmed from a single decision to save $35 a month. That bare-bones policy wasn't a shield. It was a sieve, letting the most devastating financial blows pass right through to him. Mark's story isn't an exaggeration. It happens every single day across the country. People who think they are protected find out, in the worst possible way, that they are critically underinsured. The state minimum is not a recommendation from a financial expert. It is simply the lowest bar the government has set to let you legally operate a vehicle. It's designed to provide a minimal, tiny cushion for society, not to fully protect your personal assets. Let's break down the coverage that failed Mark. It's called liability coverage, and it's the one part of your insurance that is, in most states, non-negotiable. It doesn't cover you, and it doesn't cover your car. It covers the other people. It pays for the damage you cause to others' bodies and their property. It's usually shown as a series of 3 numbers, like Mark's 25/50/10. This is called a split limit. The first number is the bodily injury liability limit per person. For Mark, it was $25,000. That's the maximum his insurance would pay for any single person's medical bills, pain and suffering, and lost wages if he caused an accident. As we saw, a single case of whiplash can easily exceed that. A more serious injury, a broken bone requiring surgery, an overnight hospital stay, you could blow past that limit in the first 24 hours. The second number is the bodily injury liability limit per accident. For Mark, it was $50,000. This is the absolute maximum his policy would pay for all injuries combined in a single crash, no matter how many people were hurt. Imagine Mark had rear-ended a minivan with a family of 4 inside. If 3 of them had injuries totaling $20,000 each, that's $60,000. His policy would pay its max of $50,000, and Mark would be on the hook for the other $10,000, even though no single person went over the per-person limit. The third number is the property damage liability limit. Mark's was $10,000. This covers damage to other people's property, which usually means their car. But it could also be a mailbox, a fence, a storefront, or a city light pole. $10,000 might have been enough to fix a car 10 or 15 years ago. But today, with backup cameras, lane assist sensors, complex electronics, and specialized aluminum or carbon fiber parts, even a minor fender bender on a new car can easily cost more than $10,000 to repair. Hitting a Tesla or a new pickup truck could result in a $20,000 or $30,000 bill. So what's the alternative? You raise your limits. Instead of the state minimum 25/50/10, a more responsible level of coverage might be 100/300/50. That means $100,000 for a single person's injuries, $300,000 for all injuries in an accident, and $50,000 for property damage. Even better is $250/500/100. And here is the most crucial part of this entire video. The difference in price is not what you think. Going from a disastrously low 25/50/10 policy to a much safer 100/300/50 policy might only cost you $15 or $20 more per month. Think about that. For the price of a few cups of coffee, you can increase your protection by hundreds of thousands of dollars. You can buy the peace of mind that a simple mistake won't lead to financial ruin. You can protect that down payment you're saving for, protect your future earnings, and protect your family. Mark's mistake wasn't being a bad driver. His mistake was a simple miscalculation. He focused on the guaranteed savings of a few $100s and ignored the potential catastrophic risk of tens or even hundreds of thousands of dollars in personal liability. He saw insurance as an expense to be minimized, not as a vital tool to protect his entire financial life. So far, we've only talked about the damage you can do to other people. But what happens when your own car is damaged? What if you need money for your own medical bills? And what happens if the person who hits you is just like Mark with the cheapest policy possible? Or worse, what if they have no insurance at all? That's where the other pieces of the auto insurance puzzle come in, and they are just as critical to understanding how to be truly protected without overpaying. Imagine this. You're sitting at a red light, humming along to your favorite song, maybe thinking about what to make for dinner. Suddenly, wham! You're jolted forward. A sickening crunch of metal and plastic. You've been rear-ended. You take a deep breath, check to make sure you're okay, and get out of the car. The driver of the other car, a beat-up sedan, stumbles out, apologizing profusely. "I'm so sorry, I was looking at my phone. I just didn't see you stop." It's frustrating, but these things happen. That's what insurance is for, right? You exchange information, or at least you try to. When you ask for his insurance card, he gets a panicked look in his eyes. He shuffles his feet, avoids eye contact, and finally mumbles the 6 words that can turn a simple accident into a financial nightmare. I don't have insurance." In that moment, your world shifts. The straightforward process you imagined, his insurance pays for your car, your medical checkup, your rental, evaporates. Now who pays? Your liability insurance, the coverage we just discussed, does absolutely nothing for you in this situation. It's designed to pay for damage you cause to others. It's a shield for your assets, not a sword to fix your own problems. So with this uninsured driver standing in front of you, you are suddenly facing the full cost of your car repairs, your doctor's visits, your physical therapy, and any time you have to miss from work. Your financial future is now hanging by a thread. All because someone else decided to break the law and drive without coverage. This is not a rare, 1 in a million scenario. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. Let that sink in. 1 in 8. In some states like Mississippi, it's more than 1 in 4. Every time you pull out of your driveway, you are sharing the road with millions of people who have absolutely no way to pay for the damage they might cause you. They are financial time bombs on wheels. So, how do you protect yourself from them? This is where we introduce the unsung heroes of your auto insurance policy. Uninsured and underinsured motorist coverages. Let's call them UM and UIM for short. Think of these coverages as buying insurance on the other guy, just in case he didn't bother to buy it for himself. It's a defensive policy. It's you, protecting your family and your finances from the irresponsibility of others. Let's start with uninsured motorist, or UM coverage. It does exactly what it sounds like. If you are hit by a driver who has no liability insurance whatsoever, your UM coverage steps in and acts like the insurance that driver should have had. It comes in 2 primary forms. First, and most importantly, is uninsured motorist bodily injury, or UMBI. This is the coverage that pays for your medical expenses and the medical expenses of your passengers if you're injured by an uninsured driver. But it goes further than that. It can also cover lost wages if your injuries prevent you from working. It can even provide compensation for long-term pain and suffering. This is the coverage that prevents a car accident from bankrupting you with medical debt. The second part is uninsured motorist property damage, or UMPD. This covers the repairs to your vehicle if it's damaged by an uninsured driver. Now, if you already have collision coverage on your policy, and we'll dive deep into that in the next part, you might wonder if you need UMPD. In some cases, there's overlap. However, UMPD often has a much lower deductible than collision coverage, sometimes as low as a couple $100s. So instead of paying a $500 or $1,000 collision deductible to fix damage someone else caused, you'd pay the much smaller UMPD deductible. In some states, UMPD isn't available, and you'd rely on your collision coverage instead. But where it is offered, it's an excellent, inexpensive layer of protection for your car. This also covers you in hit-and-run scenarios, where the other driver is unidentified, and therefore, effectively uninsured. Now let's talk about the uninsured driver's sneaky cousin, the underinsured driver. This is where our friend Mark from the last part comes back into the picture. Remember Mark? He did the responsible thing and bought car insurance. But he bought the absolute bare minimum required by his state. Let's say his policy has a bodily injury liability limit of $25,000 per person. That sounds like a lot of money until it isn't. Let's replay our accident scenario. You're at the red light. Wham! But this time it's Mark who hits you. He has insurance, so you breathe a sigh of relief. But the accident is serious. You suffer a broken leg and a back injury that requires surgery and months of physical therapy. Your initial hospital bill alone is $40,000. Your lost wages add another $10,000. Your total costs quickly climb to $60,000, $70,000, $80,000 or more. Mark's insurance company is very polite. They process the claim and they send you a check for $25,000. That's it. That's all they are legally required to pay, because that was the limit of the policy Mark bought. You are now left with a $55,000 hole, and Mark, who likely bought the minimum policy because he doesn't have significant assets, has no way to pay you the rest. This is the terrifying gap where underinsured motorist, or UIM coverage, saves the day. Your UIM coverage kicks in right where the other driver's low-limit policy leaves off. It bridges that massive, financially devastating gap. If you had UIM coverage with a limit of $100,000, it would cover the remaining $55,000 of your bills, protecting you completely. Without it, you're on your own. You could try to sue Mark personally, but as the saying goes, you can't get blood from a stone. If he had the money to pay a major lawsuit, he probably would have had better insurance in the first place. So, how much does this critical protection cost? This is the best part. For the immense peace of mind and financial security they provide, UM and UIM coverages are often shockingly affordable. We're often talking about just a few extra dollars a month. For less than the price of a couple of premium coffees, you can add a shield that protects you from hundreds of thousands of dollars in potential losses caused by a huge portion of the driving public. It is, without a doubt, one of the single best bargains in the entire world of insurance. In many states, these coverages are mandatory. The state has decided the risk is so great that you must carry it. In other states, it's optional, but your insurance company is required by law to offer it to you, and you often have to sign a special form to officially reject it. They make you put in writing that you understand the risk you're taking by declining it. That should tell you everything you need to know about how important it is. So here is your homework. After you finish this video, I want you to find your own auto insurance policy. Look for the declarations page. That's the summary of your coverages and limits. Find the lines for uninsured and underinsured motorist coverage. First, see if you even have it. If you don't, your next call should be to your agent or insurance company. Second, look at the limits. A very common and wise piece of advice is to match your UM and UIM limits to your own bodily injury liability limits. The logic is simple and powerful. You should want to protect yourself and your family to the exact same degree that you are protecting a stranger you might accidentally injure. If you feel that your assets are worth protecting with $100,000 of liability coverage, then surely your own health and financial well-being are worth protecting to that same level. We've now built the foundation. We understand liability, protecting you from others. And we understand uninsured and underinsured motorist coverage, protecting you from others. These coverages are all about the catastrophic financial events that can happen when people and cars collide. But what about just your car? We've talked about what happens if you hit someone, and what happens when an uninsured driver hits you. But what about all the other stuff? What if you hit a deer on a country road? What if a hailstorm turns your car's roof into a golf ball? What if a tree branch falls on your hood during a storm? Or you simply back into a pole in a parking lot? None of the coverages we've discussed so far would pay a single dime to fix your car in those situations. That's where the coverages that protect your property, no matter who or what is at fault, come into play. And understanding the crucial difference between them is the key to not overpaying for protection you don't need, while not being dangerously undercovered when you need it most. So let's break down these two critical coverages: collision and comprehensive. Think of them as two entirely different types of bodyguards for your car. They both protect your vehicle, but they specialize in defending against completely different threats. First up is collision coverage. The name says it all. This is the coverage that pays to repair or replace your car if it's damaged in a collision with another object. That object is most often another vehicle, but it could also be a streetlight, a guardrail, a building, or even a pothole that causes you to lose control and hit a tree. It also covers damage from your vehicle rolling over. The key word here is impact. If your car is in motion and it hits something or it flips, that's a job for your collision coverage. It doesn't matter who was at fault. If you rear-end someone, your liability insurance pays for their car, but your collision insurance is what pays to fix your car. If someone runs a red light and T-bones you, their liability insurance should pay for your car. But if they're uninsured, or if the fault is disputed and takes months to sort out, your collision coverage can step in, pay for your repairs immediately, and then your insurance company will go after the other driver's company for reimbursement. It's your fast track to getting your car back on the road after an accident. Now let's talk about its partner, comprehensive coverage. This is the one that causes the most confusion, but it's actually pretty simple. The easiest way to think about comprehensive is that it covers almost every other kind of physical damage to your car that isn't a collision. In fact, many insurance policies officially call it other than collision coverage. This is the bodyguard that protects your car when it's just sitting there, or from forces of nature and bizarre events completely outside of your control. We're talking about things like theft. If your car is stolen, comprehensive coverage pays you for its value. Vandalism. Someone keys your car or smashes a window. Fire. Natural disasters like a flood, a hurricane, or a tornado. It covers damage from falling objects, like a tree branch in a windstorm or a chunk of ice off a roof. Hail damage is a huge one. Those little dents all over your hood and roof are a classic comprehensive claim. And here's a big one that surprises people: hitting an animal. If you swerve to miss a deer and hit a tree, that's a collision claim. But if you hit the deer directly, that's a comprehensive claim. The logic is that you can't really be at fault for a deer suddenly jumping in front of your car. So you have collision for crashes and rollovers and comprehensive for theft, weather, animals, and other non-driving related damage. They are almost always sold together. And if you have a loan or a lease on your vehicle, your lender will 100% require you to carry both. Why? Because until you pay it off, the bank technically owns the car. It's their asset, and they are legally requiring you to protect their investment from every conceivable threat. But here's the multi-thousand-dollar question, especially for those of us seeking the lowest possible insurance premium. If your car is paid off, do you actually need them? This is where you have to stop thinking like a car owner and start thinking like a financial analyst. The decision to carry collision and comprehensive on a paid-off car boils down to a simple, and sometimes brutal, cost-benefit analysis. The first thing you must understand is a term called actual cash value, or ACV. This is one of the most misunderstood concepts in all of auto insurance. If your 10-year-old car is totaled, your insurance company is not going to buy you a brand new one. They aren't even going to give you what you originally paid for it. They are going to pay you the actual cash value, what your specific car with its specific mileage, options, and condition was worth in the open market the second before it was destroyed. You can get a good estimate of your car's ACV by looking it up on sites like Kelley Blue Book or Edmunds. Now, armed with that number, you can make an informed decision. Let's say your 2012 sedan has an ACV of $4,000. You look at your insurance policy and see that you're paying $600 per year specifically for the collision and comprehensive portion of your premium. You also have a $1,000 deductible. A deductible is the amount of money you have to pay out of pocket for a claim before the insurance company pays a single cent. So, in a worst-case scenario where your car is completely totaled, the absolute maximum payout you could ever receive from your insurance company is $3,000. That's the $4,000 value of your car minus your $1,000 deductible. So the question becomes, are you willing to pay $600 a year to protect a potential $3,000 payout? For the first year, maybe. But what about the second year? Now you've paid $1,200 in premiums. The third year, $1,800. After 5 years, you will have paid $3,000 in premiums just to protect a $3,000 asset. And all the while, your car's value is depreciating, meaning that potential payout is getting smaller and smaller every year. A good rule of thumb many financial experts use is the 10% rule. If the annual cost of your collision and comprehensive premium is more than 10% of your car's actual cash value, it's time to seriously consider dropping the coverage. In our example, 10% of the $4,000 car is $400. Since the premium is $600, which is more than $400, the 10% rule suggests it's no longer a good value. Dropping these coverages is the single biggest way to slash your insurance bill. Can often cut your premium in half, but it is a calculated risk. You are essentially choosing to self-insure. You're betting that the money you save in premiums over the years will be more than enough to cover a major repair, or even buy a replacement used car if something catastrophic happens. If you drop the coverage and get into a major at-fault accident the next day, you will get $0 for your car. You'll have to pay for repairs or a replacement entirely out of your own pocket. This strategy only makes sense if you have a solid emergency fund and could absorb that financial hit without it ruining you. If you decide the risk is too great and you want to keep the coverage, you still have a powerful tool to lower your premium: the deductible. Remember, the deductible is your share of the repair cost. Insurance companies love when you take on more risk, and they will reward you for it. Raising your deductible from, say, $500 to $1,000 can lower your collision and comprehensive premium by 15% to 30%, sometimes even more. It's a direct trade-off. You agree to pay more upfront in the event of a claim, and in exchange, the insurance company gives you a lower bill every month. Again, this only makes sense if you know for a fact that you could write a check for that higher deductible amount tomorrow without breaking a sweat. So, when you look at your policy, don't just see a single price. See it as a series of choices. Liability protects others, but collision and comprehensive protect you. They protect your asset. Your job is to determine the real-world value of that asset, weigh the cost of protecting it, and decide if the price of that protection is worth the peace of mind. For a new car with a big loan, the answer is an absolute yes. For an old beater that's paid off, the answer is very likely no. For the millions of cars in between, it's a personal financial decision that you now have the tools to make intelligently. But we're not done protecting ourselves yet. We've covered damage to other people's property and damage to our own property. But what about the most valuable thing of all? What about injuries to you and your passengers? What happens when the person who hits you has no insurance, or not enough to cover your medical bills? That's where two other optional, but incredibly important coverages come into the picture. Let's talk first about the nightmare scenario. You're driving perfectly, following all the rules, and someone blows through a stop sign and plows into the side of your car. It's clearly their fault, but as you're exchanging information, they look down at their shoes and mumble the words every driver dreads. I don't have insurance. Or maybe they do have insurance, but it's the absolute bare minimum policy required by the state. Your hospital bills are already climbing towards $75,000, but their policy only covers $25,000. What happens to the other $50,000? Who pays for that? Who pays for your lost wages while you recover? The physical therapy? The long-term pain and suffering? Without the right protection, the answer is terrifyingly simple: you do. You are on the hook for someone else's catastrophic mistake. This is precisely why uninsured and underinsured motorist coverage, often abbreviated as UM and UIM, exists. Think of it this way: you are essentially buying an insurance policy for the other guy, just in case he didn't bother to buy one for himself. It's a safety net you create to protect yourself from the irresponsibility of others. Let's break it down. Uninsured motorist bodily injury, or UMBI, steps in when an at-fault driver has zero insurance. It can help pay for your medical expenses, your passengers' medical expenses, and critically, things your health insurance won't touch, like lost income and compensation for pain and suffering. It's designed to make you whole again, to put you back in the financial position you were in moments before the crash. Now, underinsured motorist bodily injury, or UIMBI, is slightly different but just as crucial. This applies when the at-fault driver has insurance, but their liability limits are too low to cover the full extent of your injuries. Remember our example? The driver had a $25,000 policy, but your bills were $75,000. If you had a UIMBI policy with a limit of, say, $100,000, your policy could step in to cover that $50,000 gap, all the way up to your limit. Without it, you'd be forced to either absorb that cost yourself or attempt the long, expensive, and often fruitless process of suing the at-fault driver personally for their assets they likely don't have, which is why they had minimum insurance in the first place. And it's not just about injuries. There's also uninsured motorist property damage, or UMPD. This helps pay to repair or replace your car if it's damaged by an uninsured driver. In some states, it can also cover hit-and-run accidents. This can be a smart, lower-cost alternative to carrying the more expensive collision coverage we'll talk about later, if you're primarily worried about being hit by someone without insurance. Now you might be thinking, this sounds expensive. I'm trying to get low-cost insurance. But here's the reality check. The Insurance Research Council estimates that about 1 in 8 drivers on the road in the United States is uninsured. That's a 12.5% chance that the person in the car next to you has no way to pay for the damage they might cause. For the level of financial armor it provides, UM/UIM coverage is often shockingly affordable, adding just a few dollars to your monthly premium. Skipping it is one of the biggest gambles you can take on the road. Okay, so UM/UIM protects you from the other guy. But what if the accident is your fault? Or what if it's a single-car accident? You swerve to miss a deer and hit a guardrail. Or what if fault is complicated and it'll take weeks or months for the insurance companies to decide who pays? Your health insurance might eventually cover some things, but you need medical attention now. The ambulance doesn't wait for a liability investigation. This is where the second category of crucial protection comes in: medical payments coverage and personal injury protection. Let's start with the simpler one, medical payments coverage. often called MedPay. This is one of the most straightforward and helpful coverages you can buy. MedPay covers medical and funeral expenses for you and your passengers after an accident, regardless of who is at fault. It's typically sold in smaller amounts like $1,000, $5,000, or $10,000. The beauty of MedPay is its speed and simplicity. There is usually no deductible and no copay. If you have a $5,000 MedPay limit and you go to the emergency room with a $2,000 bill, that bill gets paid, period. It's the first line of defense. It can cover the ambulance ride, the ER visit, dental work if you injured your teeth, x-rays, and even health insurance deductibles. It's immediate peace of mind. Now, if MedPay is a helpful first aid kit, then Personal Injury Protection, or PIP, is the fully stocked paramedic bag. PIP is required in certain states known as no-fault states. The whole idea behind a no-fault system is to speed up payment for injuries. Instead of waiting for a long investigation to determine who is at fault, each driver's own PIP coverage pays for their initial medical bills. This gets you the care you need faster and helps keep smaller injury claims out of the court system. Because of this, PIP coverage is much broader than MedPay. Yes, it covers medical bills, but it goes so much further. The most significant benefit is that PIP can cover a percentage of your lost wages if your injuries prevent you from working. This is huge. If you're out of work for 2 months, your health insurance isn't going to help you pay your mortgage. PIP can. It can also cover the cost of essential services, things you can no longer do because of your injuries, like cleaning your house or childcare. It can cover rehabilitation costs and other expenses MedPay simply doesn't touch. At this point, a huge question probably pops into your head. Wait a minute. I have good health insurance. Why would I pay extra for MedPay or PIP? Isn't that redundant? This is one of the most common and most dangerous misconceptions in auto insurance. Relying solely on your health insurance after a car accident can be a massive financial mistake for 3 critical reasons. First, deductibles and copays. Most health insurance plans have a significant deductible you have to meet before they even start paying. It could be $1,000, $5,000, even $10,000. An ambulance ride and an ER visit can easily eat that up, leaving you with a huge bill. MedPay or PIP can pay that bill directly, or it can be used to pay your health insurance deductible for you so you have zero out-of-pocket medical costs. Second, who is covered? Your health insurance covers, well, you, and maybe your spouse and kids if they're on your plan. But what about your friends? What if you're carpooling to work with a colleague, or driving your kids' friends to a soccer game, and you get in an accident? Are you prepared to tell them they're on their own for their medical bills? MedPay and PIP cover any passenger in your vehicle at the time of the accident. It's a way to take responsibility and protect the people you care about. And third, and this is the big one, scope of coverage. Your health insurance pays for health care. That's it. It does not pay for lost wages. It does not pay for rehabilitation equipment. It does not pay for a home health aide. And it certainly does not pay for funeral expenses. PIP, in particular, is designed to fill these exact gaps that health insurance leaves wide open. Furthermore, some health insurance policies actually have what's called a subrogation clause, meaning if they pay for your accident-related injuries, they will seek reimbursement from any settlement you get from the at-fault party's auto insurance. Some even have exclusions specifying that auto insurance must be the primary payer for car accident injuries. It gets complicated fast. MedPay and PIP simplify everything by providing immediate, no-fault funds right when you need them most. So when you're looking at that quote and trying to decide where to save money, think about the real cost. A few extra dollars a month for $5,000 in MedPay could prevent a $5,000 emergency room bill from hitting your credit report. A few dollars more for uninsured motorist coverage could prevent a $100,000 medical nightmare caused by someone else from bankrupting your family. These aren't just line items on a policy. They are your financial body armor in a world full of unpredictable risks. We've now built a pretty solid fortress. We have liability to protect our assets from others, and we have UM, UIM, MedPay, and PIP to protect ourselves and our passengers from injury. We've covered hitting other people, and we've covered getting hit by other people. But we still haven't talked about the single biggest asset in this whole equation: your car itself. What happens when your car is mangled in a wreck, or stolen from your driveway, or smashed by a falling tree? That requires a whole different type of protection, and it's where the cost of your insurance can truly skyrocket, or where you can find some of the biggest savings. We'll break that down next. So, we've talked about protecting other people's property and their medical bills with liability coverage. That's the bare minimum, the legal foundation of your policy. But let's be honest, when you're thinking about insurance, a huge part of the worry is about your car. What happens if your pride and joy, the vehicle you rely on every single day, gets wrecked? What if it's stolen from your driveway or smashed by a falling tree? That requires a whole different type of protection, and it's where the cost of your insurance can truly skyrocket, or where you can find some of the biggest savings. We'll break that down next. This is the world of two coverages you've definitely heard of, but might not fully grasp: collision and comprehensive. Think of these as the insurance for the actual physical metal, glass, and rubber that makes up your car. They are almost always optional, unless a bank has a lien on your vehicle, and they are the coverages that separate a basic, legal-to-drive policy from what people consider full coverage. Let's start with collision. It is exactly what it sounds like. It covers damage to your car when you collide with something. That could be another vehicle, a telephone pole you swerve to avoid, a guardrail on a slippery road, a curb you didn't see, or even if you flip your car over. The most important thing to understand about collision coverage is that it pays to repair or replace your car regardless of who is at fault. This is a critical point. Let's say someone runs a red light and plows into you. In a perfect world, their liability insurance, the coverage we just talked about, pays for your car repairs. But what if they don't stop? What if it's a hit and run? Or what if they have the absolute state minimum insurance, and your car is worth $50,000 and their policy only covers $10,000? You'd be stuck trying to sue them for the rest, which can take years and cost a fortune in legal fees. Or let's face it, what if the accident is your fault? We all make mistakes. You look down to change the radio station for a split second, and you rear-end the car in front of you. Your liability coverage will pay for their car's damage, but what about yours? Without collision coverage, you are completely on your own. You're looking at a multi-thousand-dollar repair bill that you have to pay out of pocket right then and there. With collision, you pay your deductible, we'll get to that in a minute, and the insurance company cuts a check for the rest. It turns a potential financial catastrophe into a manageable, predictable expense. Now, what about everything else? What about all the bad things that can happen to your car that don't involve a collision? That's where comprehensive coverage comes in. The easiest way to think about comprehensive is this: it's for damage from acts of God and criminals. It's the unpredictable, non-driving related chaos of the world. This covers a huge list of potential disasters. A hailstorm that leaves your car looking like a golf ball. That massive tree branch that snaps off during a windstorm and crushes your roof. A deer that decides to leap out in front of you on a dark country road. Technically, hitting an animal is a comprehensive claim, not a collision claim, a weird but important distinction. It also covers fire, floods, riots, and vandalism, like someone keying your car or breaking a window. And, most importantly for many people, comprehensive covers theft. Imagine that gut-wrenching feeling. You walk out to your driveway in the morning, and your car is just gone. That empty space is a pit in your stomach. Without comprehensive coverage, that's the end of the story. You file a police report and you start saving up for a new car from scratch. But with comprehensive, it's still a horrible experience, but it's not a financial wipeout. After you pay your deductible, the insurance company will pay you the actual cash value of your stolen vehicle. So here's the million-dollar question. Do you actually need these coverages? For many people, this is the single biggest decision that impacts their premium. First, the easy answer. If you have a loan on your car or if you are leasing it, you don't have a choice. The bank or leasing company technically owns the car, and they will absolutely require you to carry both collision and comprehensive to protect their asset. For them, it's non-negotiable. But what if you own your car outright? What if you have the title free and clear? Now you're in the driver's seat, and you have to make a calculated financial decision. You have to decide if you want to self-insure. This comes down to two simple questions. Question number 1. What is your car actually worth? Not what you paid for it, not what it's worth to you sentimentally, but what is its actual cash value today? You can get a pretty good idea from sites like Kelley Blue Book or Edmunds. If you're driving a 15-year-old beater that's worth maybe $2,000, does it make sense to pay $800 a year for collision and comprehensive? Probably not. You'd be paying 40% of the car's total value every single year for the coverage. Question number 2, and this is the most important one. If your car were totaled tomorrow in an accident that was your fault, could you comfortably write a check to replace it without destroying your finances? Do you have an emergency fund with enough cash, $5,000, $10,000, $15,000, set aside that you could use to go buy another reliable car and not miss a beat? If the answer is yes, then you are a prime candidate to consider dropping collision and comprehensive and saving a huge amount of money. You are effectively making a bet on yourself, saying, "I'll take the risk. I'll save the premium money, and if something bad happens, I'll cover it myself." But if the answer is no, if totaling your car would mean taking on debt, being unable to get to work, or a major financial crisis, then you absolutely need to keep this coverage. It's not just insurance for your car. It's insurance for your lifestyle and your financial stability. For many, that peace of mind is worth every single penny of the premium. Okay, so let's say you need it or you just want the peace of mind. How do you get the cost down? This is where you can take real control. The single most powerful tool you have to lower your collision and comprehensive premium is your deductible. A deductible is simply the amount of money you agree to pay out of pocket for a claim before the insurance company pays a dime. It's your share of the risk. Deductibles typically range from $250 all the way up to $2,000. And the relationship is simple. The higher your deductible, the lower your premium. Raising your deductible from, say, $500 to $1,000 can sometimes lower your premium for these coverages by 20 or 30% or even more. You're telling the insurance company, "Look, I'm not going to bother you with every little scratch and dent. I can handle the small stuff. I just need you to protect me from a total loss." But there is a golden rule here. Never, ever set your deductible higher than an amount you have readily available in cash. If you choose a $1,000 deductible, you must have that $1,000 sitting in a savings account, ready to be deployed at a moment's notice. A high deductible you can't afford is just as useless as no insurance at all. Another smart strategy is to apply what some call the 10% rule. Take a hard look at your policy. Find the specific line item costs for your collision and comprehensive coverage for the whole year. Let's say it's $600. Now look up your car's value. Let's say it's $4,000. Is paying $600 a year, which is 15% of your car's total value, worth it? Many financial advisors say that if the annual cost of the coverage exceeds 10% of the car's value, it's time to seriously consider dropping it and banking the savings instead. So we've covered damage you do to others and damage that happens to your own car. But what happens when the lines get blurry? What happens when the other driver is clearly at fault, but they have no insurance or not enough to cover your brand new SUV? You could sue them, or you could have a secret weapon on your policy that protects you from the irresponsible drivers of the world. It's called uninsured and underinsured motorist coverage, and it might be the most important and most misunderstood coverage you can buy. Let's play out a scenario. You're driving home from work on a Tuesday afternoon. The light turns green, you proceed through the intersection, just like you've done 1,000 times before. Suddenly, out of the corner of your eye, you see a flash of red. A car, blowing through their stop sign at 50 miles an hour, slams directly into your driver's side door. The world spins. Metal shrieks. Glass shatters. When you come to, paramedics are helping you out of what's left of your car. You're hurt, your car is totaled, but you're alive. At the hospital, you learn you have a broken arm and a concussion, meaning you'll be out of work for weeks, maybe months. But you think, okay, I have insurance. And the other driver was clearly at fault. Their insurance will have to cover this. Then you get the call from your agent. The other driver. They didn't have insurance. Not a single penny of it. In that one moment, your entire world shifts. Suddenly, the mountain of medical bills? They're your problem. The lost wages from being unable to work? Your problem. The thousands of dollars to replace your car? Your problem. The other driver is what the industry calls judgment-proof. They have no assets, no coverage, nothing. You can sue them, sure, but you can't get blood from a stone. You did everything right. You paid your premiums, you drove safely, you followed the law. And yet, you are on the hook for a six-figure catastrophe because someone else broke the rules. This isn't some far-fetched horror story. It happens every single day. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. Look at the next 8 cars that pass you on the highway. Statistically, one of them is a financial ghost, a ticking time bomb with no safety net. In some states, it's far worse. In Mississippi, it's 1 in 4. In Florida, it's 1 in 5. This is precisely why uninsured and underinsured motorist coverage exists. It is your personal shield against the financial irresponsibility of others. Think of it this way. When an uninsured driver hits you, your own insurance company steps into the shoes of the at-fault driver's non-existent insurance company. Your policy pays you for the damages that the other driver should have paid for. It's a safety net you buy for yourself because you cannot trust that the other 150 million drivers on the road have their act together. Let's break down the two critical parts of this coverage. First, you have uninsured motorist coverage, or UM. This is for the exact scenario we just described. The at-fault driver has zero insurance, or it's a hit and run and the driver is never found. UM coverage typically comes in two flavors: bodily injury and property damage. Uninsured motorist bodily injury, or UMBI, is the heavyweight champion. This is the coverage that pays for your medical bills, your ambulance ride, your physical therapy. It covers lost wages if you can't work. It can even provide compensation for long-term pain and suffering. This is the coverage that prevents a car accident from turning into a personal bankruptcy. Then there's uninsured motorist property damage, or UMPD. This, as the name implies, covers the damage to your car. It pays to repair or replace your vehicle if it's damaged by an uninsured driver. Now you might be thinking, wait, don't I have collision coverage for that? And you might. If you have collision coverage, it will also pay for the repairs regardless of who is at fault. In many cases, UMPD is a bit redundant if you already have collision. However, the deductible for UMPD is often much lower than your collision deductible. We're talking maybe a $250 deductible for UMPD versus a $1,000 deductible for collision. So it can still save you a significant amount of cash out of pocket. Some states don't even offer UMPD, requiring you to use your collision coverage instead. So that's uninsured motorist, for when the other guy has nothing. But what about the second part of the equation? What if the other driver isn't a complete ghost? What if they have insurance, but it's just really, really bad? This is where underinsured motorist coverage, or UIM, comes in. This is arguably even more common and more insidious. Let's go back to our crash scenario. But this time the at-fault driver does have insurance. They have the absolute bare minimum liability coverage required by their state. Let's say their state requires just $25,000 in bodily injury liability per person. Now let's look at your bills. The ambulance ride was $2,000. The emergency room visit was $15,000. The surgery to set your broken arm was $30,000. Follow-up appointments and physical therapy will be another $20,000. You've already missed a month of work, costing you $5,000 in lost income. Your total damages are approaching $72,000, and the at-fault driver's policy taps out at just $25,000. Who pays the remaining $47,000? Without underinsured motorist coverage, you do. That gap is entirely your responsibility. But if you have UIM coverage, your own policy steps in to cover that difference up to your policy limits. It bridges the gap between your actual damages and the piddly little policy the other driver was carrying. Just like UM, underinsured motorist coverage is also split into bodily injury, UIMBI, and property damage, UIMPD. The bodily injury portion covers the shortfall on your medical bills and lost wages, and the property damage portion covers the shortfall on your car repairs if their property damage liability limit isn't enough to fix or replace your vehicle. So, how much of this coverage should you have? This is one of the most critical decisions you will make on your policy. A good rule of thumb, and what most financial experts recommend, is to carry UM/UIM limits that are at least equal to your own bodily injury liability limits. Think about the logic there. Your liability limits are the amount you think is appropriate to protect other people from harm you might cause. If you have $100,000 in liability coverage, you're saying, if I cause an accident, I want to have at least $100,000 available to make that person whole. So the question is, aren't you and your own family worth the same level of protection? If you're willing to protect a stranger to that degree, you should be willing to protect yourself to that same degree from an irresponsible driver. Now let's talk about a powerful feature that many people don't even know exists: stacking. In many states, if you have multiple vehicles on your policy, you may have the option to stack your uninsured/underinsured motorist coverage. Let's say you have two cars, and each one has $100,000 of UMBI coverage. If you have non-stacked coverage, and you get into an accident in car A, you only have access to that car's $100,000 limit. But if you have stacked coverage, you can combine the limits from both vehicles. So, in that same accident, you would have $200,000 of coverage available, $100,000 from car A plus $100,000 from car B. It effectively doubles your protection. Stacking usually costs a little bit more, but the increase in your safety net is massive. Some states mandate stacking, some prohibit it, and some make it optional. It is absolutely worth asking your agent if this is an option for you. You might be listening to all of this and thinking, this sounds expensive. I'm trying to get low-cost insurance. And that's the beautiful misunderstood secret of UM/UIM coverage. It is one of the most affordable coverages you can buy for the incredible amount of protection it provides. We're often talking about a few extra dollars a month to add or increase this coverage. Compared to the risk of a $100,000, $200,000, or even $500,000 loss from an accident with an uninsured driver, it's not just a bargain. It's a financial necessity. Skipping this coverage to save $10 a month is like removing the airbags from your car to save a little weight. It's a catastrophic trade-off. I want you to do something. When this video is over, I want you to find your auto insurance policy declaration page. Look for the lines that say uninsured motorist bodily injury and underinsured motorist bodily injury. See what your limits are. Are they the state minimum? Are they zero because you waived the coverage? Or are they high enough to truly protect you and your family from financial ruin? Because at the end of the day, you can't control what other people do, but you can control how prepared you are for their mistakes. Let's play out a scenario. You're driving home on the freeway, minding your own business. Traffic slows, you slow down, but the truck behind you doesn't. You get rear-ended hard. The force shoves you into the car in front of you, which then hits the car in front of them. A 4-car pileup. And you, my friend, are the unfortunate sandwich in the middle. Your car is totaled. Your neck and back are in searing pain. An ambulance is on its way. Now, let's say the driver who caused it all, the one in the truck, has the absolute state minimum liability coverage. In many states, that's just $25,000 for property damage and $25,000 or $50,000 for bodily injury. Your brand new SUV that you just bought for $40,000? That $25,000 property damage limit is gone before the tow truck even hooks up your vehicle. And what about the other 2 cars that were damaged? The insurance company pays out that $25,000 and that's it. They're done. The rest of the cost to repair or replace the other 3 vehicles. The at-fault driver is now personally on the hook for it. And your injuries? Let's say your ambulance ride, ER visit, MRI, and initial treatment costs $30,000. And that's before any physical therapy, follow-up appointments, or potential surgery. The at-fault driver's $50,000 bodily injury limit seems okay, until you realize the person in the car you were pushed into also has $20,000 in medical bills. And the person in the front car has $15,000. That's $65,000 in medical bills for a policy that only covers $50,000. The insurance company writes the checks until the money runs out, and then their hands are clean. So who pays the rest? Who pays for the $1,000 still owed on your SUV? Who pays for your remaining medical bills and lost wages from being unable to work? The answer is terrifyingly simple: you do. You or your own insurance policy, if it's built to handle this exact situation. The at-fault driver will likely be sued and have their wages garnished for years, but that doesn't help you pay your bills right now. This is the catastrophic failure of understanding that so many people fall into. They see auto insurance as a burdensome monthly bill, a box to check to stay legal. They shop for one thing and one thing only: the lowest possible price. But what they're actually buying isn't a product. It's a promise. A promise that if the worst day of your life happens, a financial safety net will appear beneath you. A cheap state minimum policy isn't a safety net. It's a piece of string. And when you're falling, string doesn't do a whole lot of good. The real goal isn't just to find low-cost insurance. It's to find the highest value insurance. It's about getting the absolute maximum protection for the most reasonable price. And to do that, you have to sidestep the major psychological traps and industry pitfalls that lead millions of Americans into buying policies that will inevitably fail them when they need them most. The first and biggest trap is what I call the premium myopia. This is where you focus so intently on the monthly premium, that $60, $80, or $100 a month, that you completely lose sight of the other numbers. The numbers that actually matter. The liability limits, the deductible, the coverage gaps. You might save $20 a month by lowering your bodily injury liability from $100,000 to the state minimum of $25,000. That's $240 a year. Feels like a win. But in a serious accident, that savings could be the very thing that bankrupts you, forcing you to pay a $75,000 judgment out of your own pocket. You save $240 to risk your entire life savings. Does that sound like a good deal? The second major trap is the loyalty penalty. This one is insidious because it feels counterintuitive. We're taught that loyalty is a good thing, that it should be rewarded. But in the insurance world, loyalty is often punished. Insurance companies spend a massive amount of money acquiring new customers. They offer teaser rates, big discounts, and special promotions to get you in the door. But once you're in and you've been a customer for 3, 5, or 10 years, those discounts quietly fade. Your rates slowly creep up year after year. They're counting on the fact that you won't notice, or that shopping for new insurance is such a hassle that you'll just pay the renewal without question. The person who shops their insurance every single year, or at least every 2 years, will almost always pay less for the exact same coverage than someone who stays with the same company for a decade. Think about that. 2 people, same car, same driving record, same address, same coverage limits. The new customer is paying less than the loyal one. It's a penalty for your loyalty. Never ever assume your current company is giving you the best deal just because you've been with them for a long time. The only way to know is to constantly compare. This leads directly to the third, and perhaps most critical trap: the apples to oranges comparison. When people finally do decide to shop around, they often do it wrong. They go to a few websites, enter their info, and just look at the final price. They see Company A is $90 a month, Company B is $110, and Company C is $125. They pick Company A thinking they got a great deal, but they never looked at the details. They didn't realize Company A's quote had a $1,500 deductible, while the others were at $500. They didn't notice Company A defaulted to state minimum liability, while B and C quoted much higher, more protective limits. They didn't see that Company A's quote left out rental car reimbursement and roadside assistance, which the others included. You cannot compare policies on price alone. You have to compare them on coverage first, then price. The correct way to shop is to decide on the exact coverage you need before you start getting quotes. Say to yourself, I want 100/300/100 liability. I want uninsured motorist coverage to match. I want a $500 deductible for both collision and comprehensive, and I need rental reimbursement. Now, you take that exact list of coverages and you get quotes from 5, 6, even 10 different companies for that specific package. This is a true apples-to-apples comparison. Now, when Company A comes back at $90, B at $110, and C at $125, you know that the $90 quote is genuinely the best price for the protection you've decided you need. You're not sacrificing coverage for cost. You're finding the lowest cost for your desired coverage. Avoiding these 3 traps, premium myopia, the loyalty penalty, and the apples to oranges comparison, is the fundamental difference between being a savvy consumer and being a victim of the system. It's about shifting your mindset. You're not just buying a piece of paper to stick in your glove box. You are hiring a financial bodyguard. You are purchasing a multi-$100,000 promise. And when you're buying something that important, you don't just look for the cheapest option. You look for the strongest, most reliable, and most trustworthy option you can afford. Because when you're standing on the side of a freeway, watching your life get loaded onto a flatbed truck, the extra $20 a month you saved will feel like the most expensive mistake you've ever made. The real question you need to be asking isn't, what's the cheapest I can get? It's, what's the smartest way to protect everything I've worked for? And answering that question requires a strategy, a blueprint for navigating the confusing world of quotes, coverages, and companies. So let's build that blueprint right now. Let's create a 1-week action plan to completely transform your auto insurance situation. Think of this as your 7-day sprint from confusion to clarity, from overpaying to optimized protection. Day 1 is the audit. Before you can know where you're going, you have to know exactly where you are. Today you're a detective. Pull up your current auto insurance policy. Find the declarations page. Don't just glance at the total premium. I want you to look at the numbers behind the number. What are your exact liability limits? Are they 25/50/25? 100/300/100? Write them down. What are your deductibles for comprehensive and collision? Are they $500? $1,000? $2,000? Write them down. Do you have uninsured motorist coverage? Personal injury protection? Medical payments? Rental reimbursement? Roadside assistance? List every single coverage you are currently paying for and how much it covers. This isn't about judgment. It's about establishing a baseline. This is your starting point, the before picture in your financial transformation. Day 2 is the profile. Today, you're not looking at the insurance company. You're looking at yourself through their eyes. This is about gathering the intel they use to calculate your risk. First, your driving record. Go to your state's DMV website and pull your official motor vehicle record. You need to know exactly what they see. Any tickets, any accidents, any points. No surprises. Second, your credit score. You don't need the exact number, but know the range you're in: excellent, good, fair, or poor. We've established how much this matters. Third, your vehicle. Know your exact year, make, model, and VIN, but also list its safety features: anti-lock brakes, airbags, anti-theft systems, lane departure warnings. These are discount opportunities. Finally, your usage. Calculate your real annual mileage. Don't guess. Check your last 2 service records. How far do you actually drive to work? Be honest. By the end of day 2, you will have a complete dossier on yourself as an insurable risk. This is your power. Day 3 is the digital gauntlet. It's time to go online, but we're going to do it strategically. Use at least 2 major online comparison websites. The key here is consistency. Using the profile you built on day 2, you will enter the exact same information on every site. The same liability limits you want to quote, the same deductibles, the same annual mileage. This creates a controlled experiment. Your goal isn't to buy today. Your goal is to gather data. You're mapping the market. You'll see which big-name national carriers are competitive for someone with your profile. You'll also see names of smaller, regional companies you've never heard of. Make a list. Note the top 3 to 5 most competitive quotes. This is your initial shortlist. Don't get distracted by the ads or the pressure to buy now. You are in the intelligence gathering phase. Day 4 is the human connection. Digital tools are great for speed, but they can't understand nuance. Today you pick up the phone. First, call an independent insurance agent. These agents work with multiple companies, not just one. Give them your profile from day 2. And tell them the best online quote you found on day 3. Then ask the magic question. Can you beat this? And more importantly, can you tell me why a particular company is a better fit for me? They might have access to carriers that don't even show up on comparison sites. Or they might identify a critical coverage gap in the cheap online quote. Second, if one of the companies on your shortlist was a captive agent company, like State Farm or Allstate, call a local agent directly. Again, build a relationship. Ask questions. See how they treat you. A great agent is a powerful advocate to have in your corner when something goes wrong. Today is about finding out if there's a human expert who can add value beyond what an algorithm can offer. Day 5 is the discount deep dive. This is where you get granular and claw back every single dollar you're entitled to. Take your short list of companies from the last 2 days. Go to each of their websites and find the discounts page. Print it out if you have to. Now go through it line by line with your profile from day 2 in hand. Good student discount? Check. Defensive driving course? Is it worth taking for the discount? Bundling home or renter's insurance? Get a quote for that too. Anti-theft device? Yes. Low mileage? You know your exact number. Paid in full discount? Ask about it. E-pay and paperless billing? Easy money. Affiliation discounts? Are you part of a university alumni group? A credit union? A professional organization? Look it up. And finally, ask about telematics. Understand the program, the data it collects, and the potential discount range. By the end of today, you're not just accepting the first price they gave you. You are actively carving out the lowest possible price with each contender. Day 6 is the decision matrix. Price is not the only factor. A cheap policy from a terrible company is one of the most expensive mistakes you can ever make. Today you become an analyst. Create a simple spreadsheet. In the first column, list your top 3 companies. In the next columns, list their final post-discount 6-month premium. But now we add more columns. Go to J.D. Power and Associates and look up their auto insurance claim satisfaction ratings. Put that score in the next column. Go to your state's Department of Insurance website. They often publish complaint ratios for carriers. Put that number in the next column. Check the AM. Best rating for financial stability. Add that. Now look at the whole picture. Is the absolute cheapest company also the one with the worst claim satisfaction? Is paying an extra $10 a month worth it for a company that has a stellar reputation for paying claims quickly and fairly? This matrix moves you beyond just the price tag. It allows you to make a value-based decision, weighing cost against quality and peace of mind. Day 7 is the final review and the switch. You've chosen your winner, but you don't sign yet. Ask them to send you the full, final policy documents for review. Read the fine print. Does everything match what you discussed? Are the coverages, names, vehicles, and deductibles all 100% correct? Verify everything. Only then do you make the payment and lock in your new policy. But you're not done. The final critical step is to cancel your old policy correctly. Call your old insurer and confirm the cancellation date is the same day your new policy begins. There can be no gap, not even for one day. A lapse in coverage is a massive red flag that will cost you money for years. Get written confirmation of the cancellation, and then finally you're done. You've executed the plan. This 7-day process might sound like a lot of work, and it is, but think about what you've accomplished. You've replaced confusion with a data-driven strategy. You've stopped passively accepting a bill and have actively shaped it to your needs. You've likely saved hundreds, maybe even over $1,000 a year. But more than that, you've purchased something far more valuable than insurance. You've purchased certainty. Certainty that you're not just getting a low price, but the right price. Certainty that you're not just covered, but correctly covered for your life, your assets, and your future. The confidence that comes from knowing you've made a smart, informed decision about one of your biggest household expenses is a feeling of control that no name your price tool can ever give you. You didn't just find low auto insurance. You mastered it.